This video will examine how software developer job openings correlate with federal interest rates in the United States. Based on the analysis in this video, I found out that available developer job openings correlate with how costly it is to borrow money. This cause and effect relationship means that when interest rates are low, borrowing surges and austerity is reduced. This dynamic results in more software developer jobs. After all, more money is available to hire new devs. Okay, so the correlation that I'm seeing is that when there is a low federal interest rate, there are more dev job posts / opportunities. Conversely, higher interest rates mean less borrowing, which lead to more austerity and fewer dev jobs. In other words, there is less money to hire new devs. So just to make this as dead simple as possible, when there is a high federal interest rate, that means that there are less dev job posts / opportunities. Now, I'm not going to pretend to be an economist here. Correlation doesn't always mean causation. However, as you can see, these charts,
which measure federal interest rates, software developer job postings, and inflation,
are close enough matches to reveal a pattern across the data points.
For example, in April 2020, at the start of the pandemic, the interest rate was at 0.05%, meaning it was super easy to borrow money back then. Accordingly, the inflation rate cranked up to 8% in the next 2 years. And alongside that, software developer job postings on Indeed had increased by roughly 165% by March of 2022. Inversely, as the rate started to rise closely after the job posting peak of March 2022 from 0.2% to 5.33% by September 2023, software developer job postings fell sharply by 190% from that same time period.
In short, the correlation shows that lower interest rates mean more software developer job postings, and higher interest rates mean less dev job postings. In the current software developer job market, as of July of this year, software developer job postings have decreased by an additional 17% since September of 2023, while the interest rate has remained steady at 5.33%.
Which I think can validate the struggle most applicants are feeling right now as they regularly apply for dev roles.
But it's not all doom and gloom. The correlation can help identify when we will have booms and busts in hiring. I wanted to add a little extra sauce here because I think that this correlation, although not foolproof, can be useful to you in your job search. If you know that the federal interest rate is low, that could be a good time to jump from one job to another, mainly because there are plentiful opportunities out there. Inversely, as I mentioned before, when that interest rate is high, that could be a good time to have a strategy related to hunkering down at your current job or looking for additional sources of income in case you go and get laid off. As of our most recent data, the head of the Federal Reserve, Jerome Powell, has referenced that he sees indicators that can signal opportunities for lowering interest rates again.
The Fed has set a target for inflation of 2%. Now, can you clarify, does that mean that the inflation rate has to be at 2% before you're ready to move, if you are ready to move, or does it have to be within sight? And what does it mean to be within sight?
When we change interest rates, that tightens financial conditions, and that in turn affects economic outcomes, growth, labor markets, and ultimately inflation, but with lags that can be long and variable, as Milton Friedman famously said. And the implication of that is that if you wait until inflation gets all the way down to 2%, you've probably waited too long, because the tightening that you're doing, or the level of tightness that you have, is still having effects which will probably drive inflation below 2%. So we've been very clear that you wouldn't wait for inflation to get all the way down to 2%. Our test has been for the past quite some time that we wanted to have greater confidence that inflation was moving sustainably down toward our 2% target. And what increases that confidence in that is more good inflation data. And lately here, we have been getting some of that.
The rate variations are officially declared in Federal Reserve meetings, one of which is supposed to occur at the end of this month, and the other which is set to occur sometime mid-September. If rates lower, this may mean a surge in hiring that we haven't seen for over 2 years now. But we'll have to keep our ears perked and our eyes peeled to see if we can catch the correlation in real time. If you enjoyed this video and you'd like to support the channel's growth, please make sure to subscribe. I'd like to get us to 1K subscribers. Or if you'd like to support the channel even more, you can pay $5 a month to become a patron in the link below. And in exchange, you'll get access to the official tech industry Discord chat. Here, I'm building a hive mind of industry professionals to help get you hired, paid, and working in a job that you like. Thank you for watching, and I will see you next time.